Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's about 30 minutes until the closing bell here, and tech stocks leading major averages lower on this final Monday of trading in 2025. Well, it's the final stretch of 2025 and markets are pulling back to start the holiday shortened week, but it's been a strong year for stocks, and my next guest is focused on what's been supporting this rally and whether there is still room to run. Joining me now, got Tom Essaye, Sevens Report Research founder. Tom, it is great to see you. So let's start on these pillars, Tom, that you say are holding up this market. Pillar number one, no surprise, AI. Lots of investor excitement, Tom. It's helped to carry this market in 2025. I'm curious how you see that AI trade and trend evolving in 2026, Tom.
Good afternoon, Josh. Thank you very much for having me on, and Happy New Year to everyone. Yeah, so we sort of described four pillars of the rally, and the most important and first one, as you said, is AI. And it's really been a rising tide that's lifted all boats, not just this year, but for the past 3.5 years, really. But we think that's changing a little bit in 2026. And importantly, it doesn't mean it's necessarily going away. But instead, I think that sort of AI enthusiasm is going to look a lot more like Q4 than it did, say, Q2 and Q3. And what I mean by that is that it's fractured. So we're not going to have every single tech stock just running away. It's going to become a selection of winners, say like your Micron, and then maybe some losers like your Oracle and to a point Broadcom. And I'm not saying for those stocks specifically into 2026, but more as an example that we're going to have to be selective as AI matures.
Well, let me ask you, if AI is sort of more fractured next year, if I'm a viewer, I'm an investor, I'm listening to that, how do I discern, Tom, then the winners and losers in this AI fractured world you're describing?
So for me, I look at AI as sort of a cycle that's maturing, right? And really the first stage was sort of, it was the epiphany stage, right? Oh my gosh, we can do this. And then in order to do this, the first thing we need is semiconductors. And now we're going to run out and buy all the semiconductors that we can. And obviously Nvidia, Broadcom, Taiwan Semi have benefited fantastically from this. I see it evolving a bit now into those companies that are really taking the leading edge. Probably my top AI pick for 2026 is Google. I like Gemini 3. I think their advantage on search gives them a huge sort of chip in the game against OpenAI. So I like Google from a search standpoint. I also like the memory because that's sort of the next stage of this data center build out, right? We need the compute power. Well, now all of a sudden we need all the memory to power all that we need. So I see it more of an infrastructure play evolving towards memory on the infrastructure side, but then also from sort of the hyperscalers, I really like Google with YouTube and then with Gemini 3.
Another pillar you talk about here, Tom, is economic growth. It's looked stable, it's looked resilient. You are watching the labor market. How do you see that labor market evolving, Tom? What do you see now and ahead?
So the labor market is not bad, right? The only reason we're even talking about it is really because it's been so good for so long. I mean, there was a time, Josh, you can remember this, when we all would have prayed for 4.6% unemployment. Now we see it and we're starting to get a little bit nervous. But here's the rub. We are stuck in a no hire, no fire labor market. That means that people aren't being laid off en masse, which is a good thing, but they're not really being hired either. And whether that's AI's fault or just the economy's fault doesn't really matter. It doesn't take much to go from a no hire, no fire to all of a sudden a contracting labor market. And the labor market is really what's keeping this economy afloat through the affordability crisis. If people start losing their jobs and they have to start cutting back forcefully, then all of a sudden the affordability crisis gets exponentially worse. And that's the type of thing that can cause a recession. Watch 5% in the unemployment rate. If we get close to it early and breach it in the first half, that is a bad economic signal.
Another pillar, rate cuts. Tom, how many cuts do you think we get next year? What's your base case?
So I'm inclined to go with 2, because I think that the Fed is sort of telling you there's one, right? And then I think we get a new Fed chair, and it doesn't matter whether it's one of the Kevins or somebody else. I think they probably push for an additional one. But I don't think we're going to see the type of consistent rate cut cycle that we have expected over the past 2 years. So there's room for disappointment on the 2. And if it's going to be a surprise, I think it's a surprise less.
Does the market, Tom, in your opinion, does it need those cuts to move higher in 26?
Yeah, I think it does. I think that sort of the synopsis of the pillars of the rally, the review, is essentially that they're all still in place, but all of them are weaker than they've been in the past couple of years. So it sort of begs the question, what's going to push us higher? Well, we need some positive surprises, right? And sure, AI can provide it, and sure, growth can be better than expected. But if we get a suddenly more dovish Fed that doesn't mess up the confidence of the market in Fed independence, then all of a sudden that could be a pretty good tailwind. Because if the doves are right and rates are still way too high, then that could really goose the economy and that could help the whole market. Final
pillar here, Tom. You mentioned tariff clarity. So what do you think we're going to hear from the Supreme Court, Tom? You think they're going to rule those Trump tariffs are illegal?
I do. I mean, I'm certainly not a legal scholar, but everybody that I read seem to think that same thing's going to happen. And then it's a big question of what if, right? What happens? I think most people expect that the Supreme Court just says, you know what, they're struck down, and the lower courts, you figure out what to do with the refunds. That's not the biggest issue. The biggest issue is then what does the administration do? And do they reapply for these tariffs? And then are they immediately sued? And do we go through this process over and over and over again in sort of a perma uncertainty? And what does that do to the economy? I think one of the biggest surprises of 2025 is that apparently you can jack tariffs up the highest in decades and it doesn't really break anything. Well, maybe it didn't break anything yet. And I think that we need to not be complacent about the risk that this takes over time. The longer these things hang on, the more of an impact they can have.
Tom, great to have you on the show today. Appreciate your time. Happy New Year.
Happy New Year.
All right, now time for some of today's trending tickers. We're going to start here with Lululemon. Founder Chip Wilson launching a proxy fight. Wilson's hoping for a change on the company's board as it searches for a new CEO. That's according to the Wall Street Journal. Earlier this month, remember, Lululemon announced current CEO Calvin McDonald's plans to step down from his role and as a member of the company's board of directors. Soon after the announcement, activist investor Elliott Investment Management took a $1 billion stake in the company, pushing for a former Ralph Lauren executive to take the helm. Turning to tech, Amazon halting its plans for drone delivery in Italy. Company noting that the broader business regulatory framework in that country does not support longer-term objectives for its program. Amazon also, by the way, getting a bullish call from Evercore ISI. Analyst Mark Mahaney sees about 50% upside potential in 2026, citing several catalysts coming into focus, including re-accelerating growth at AWS. Yahoo Finance data shows that out of the 67 sell-side analysts that cover Amazon, 96% rate that stock a strong buy or buy. And lastly, a look at 8Co as those shares surging in today's trade. The WorldCoin Treasury Company, chaired by Dan Ives, announced a share buyback program of up to $125 million. Ives saying in a statement that the public stock is becoming an increasingly attractive investment based on 8Co's current valuation and its pipeline for additional partnerships. Well, coming up, Strategy shares his playbook for AI stocks heading into 2026. That's next on Market Domination. Investing in AI has been a dominant theme in 2025, with tech stocks helping to drive the NASDAQ up more than 20% this year. But there are growing concerns, we know, that AI stocks could be overvalued heading into 2026. Joining me now, we've got Corey Johnson, Epistrophe Capital Research Chief Market Strategist and the Drill Down podcast host. Corey, my friend, always great to see you. Let's start here, Corey. We're wrapping up 2025. You're looking at the Mag 7, Corey, and the divergences here they're interesting, Corey. They're noteworthy. And over the past year, Google, it's a rocket ship. We know this. Nvidia, strong. Amazon, not so much. And I'm curious what you make of that, Corey. What you think investors are looking for. Is it monetization, Corey, or investors looking for, okay, who controls the whole stack? Explain it for us. What do you think's going on?
I think the construct of the Mag 7 is a market phenomenon, not a business phenomenon. Which is to say, you have very different businesses under the auspices of the Mag 7 that were gathered together because of kind of the size of the businesses in general, the market caps of the companies, I should say, and the direction of their stocks. And as those start to fall apart, as they naturally, those correlations naturally will, because they are in different businesses, the whole notion of a Mag 7 is going to look sillier and sillier over time.
Let me ask you about a name, and I'm interested to get your take here. Nvidia. This deal with Groq, Corey, I want to get the Corey take here. To remind viewers, so licenses the AI technology for reportedly here $20 billion in cash. Key execs join Nvidia. What do you make of that deal, Corey? Was it a smart deal by Jensen Huang? And why did Jensen Huang decide, you know what, I'm going to structure this as licensing, not an acquisition?
Right, those are two important, different questions. So let's talk about what they're doing first and why it's different. And we can talk about this for days, except that we can't. But let's do what we can here. So the way that Groq chips are so different than Nvidia chips is the way they the way they process information. Specifically, it's a phrase that's really hot in Silicon Valley right now: deterministic programming. So deterministic, or processing, I should say. Deterministic sort of takes a big chunk of data and analyzes it all at once. So if you were to ask, the example that Groq likes to use, if you were to ask a large language model using, if you were asked ChatGPT using NVIDIA chips, what sentence uses all 26 words in the alphabet, and the answer might be, the quick brown fox jumps over the lazy dog. Well, as you type that question in letter by letter, NVIDIA's chips and the ChatGPT model is trying to figure it out letter by letter. WHATSEN, what sentence. It's trying to determine what the next thing you're going to is, and it can be kind of slow. Whereas a deterministic model using a Groq chip looks at the whole question, figures out the answer, and dishes it out to you quickly. It's a different kind of processing that uses less high bandwidth memory, uses less processing power. The chip must be more powerful to do so, but programmed to do that. It's a very different approach. And as the artificial intelligence world goes from building the models, training, to using the models, inference, the Groq chip is a different approach that might work better. NVIDIA had reasons to be concerned that they were going to lose share in the marketplace over time because of this deterministic approach being more simple and more elegant and cheaper to use over time. They're smart to get in there to try to make sure nobody else can take their lunch.
All right, so smart to get in there. You've laid out the strategic rationale. Is there regulatory risk for NVIDIA with this deal? Is there FTC risk?
Right. Hell yeah. This is a huge risk. It's why they structured the deal this way, one would think, because the biggest company in the world with 95% market share in the GPU market, going out and buying maybe their biggest competitor in the future, not AMD, not Intel, not Huawei, right? But this Groq company has a very different approach to doing this. And to be sure, I've invested in a company called Positron AI that is in some ways a competitor to Groq and has some former Groq employees. So I've got some conflict here. I want to make sure all the viewers know what I'm talking about, why I'm hedging my bets here. But I think that what's interesting here is that if this were a clear acquisition, it would be a clear problem with the FTC. This is a less clear problem, except that the FTC has already gone out there and done some investigations of similar kinds of deals at Google and Microsoft and others as it relates to AI and chips. So the FTC is going to take notice of this and notice of the nimble yoga that Jensen Huang is doing in putting this deal together in a way that might avoid a Hart-Scott-Rodino review, but might not after all. Now, with a Trump FTC, and with President Trump's reported friendship with Jensen Huang, who knows if that matters as much. But clearly this is NVIDIA trying to take a competitor off the boards.
Well, let me ask you, I am curious, the potential consequences of this deal, Corey, what would be, in your opinion, some of the ripple effects investors would need to look out for in terms of that just broader competitive landscape?
Look, it's really exciting for the investors in this deal. I've talked to a number of them over the course of this holiday weekend because my friends have nothing else to do but text me with their celebratory moments before Christmas. But if this deal goes through, it'll be a huge gain for a lot of the investors in this company. But it also will show how NVIDIA's really got a lock on things going forward as they both own the GPU market, expand into the world of networking as they build out more and more of the systems, not just the chips and even the networking that happens within those systems and connecting those systems. But now the notion that they can just go out and use the power that they have achieved with the success of their GPUs to acquire their future competitors, it's a sign of the times that they might be stifling competition down the road.
Corey, always great to see you. Always great to have you on the show.
You too.
Happy New Year, my friend.
Happy New Year to you.
Well, Nvidia has officially taken its $5 billion stake in Intel, carrying out a transaction announced back in September. And for more on Intel's deals, let's welcome in Yahoo Finance's Laura Bratton. Laura.
How's it going?
Very good. Walk us through it.
Yeah, so Intel said in a regulatory filing today that over last week it had completed the sale of $5 billion worth of shares to Nvidia. It was a deal that was initially announced in September and really boosted confidence in Intel. The two companies are co-developing CPUs for data center servers and also chips for personal computers. So really big deal for Intel to have kind of Nvidia behind it. But notably, it doesn't include Intel manufacturing, and that's really what investors have been waiting to see, whether Intel's manufacturing business can turn around.
Now, Nvidia, that was the only deal Intel struck, right, this year. What else has changed for that chip maker?
Yeah, a lot has changed. They have a new CEO, Lipton, that really bolstered kind of investor confidence in Intel because of his wide-ranging industry connections. Pat Gelsinger, the former CEO, had undergone like a really aggressive turnaround effort, and it just cost a lot of money. And the manufacturing business, which opened up to outside customers, has been losing a lot of money. Other things that happened, the US government, really big, they invested in Intel, so did SoftBank. And the U.S. government investment was a really big deal because the thought is that, now Intel might have sway over trade policy. The U.S. government could potentially pressure some of the bigger companies to use Intel's manufacturing business.
So, and by the way, this stock, I mean, as we should mention, it's up about 80% this year.
Yeah.
It has been just a rocket ship. Most analysts, by the way, on maybe not surprising after a move like that. I mean, look at that stock chart. Most analysts at this point are on the sidelines. But what's ahead for Intel? Like, if I'm an investor in this name, Laura, what should I be looking for in 2026? What's on the radar?
Yeah, so Intel's latest manufacturing process, 18A, was a really big milestone for the company, but they didn't really get the big external customers that investors are really looking for Intel to get in order to be like, hey, this business is really, turned around. So that instead is being kind of used for Intel's own chips, but now they need outside customers for their upcoming manufacturing processes, 18AP and 14A.
Mm-hmm. All right, Laura, thanks so much. Appreciate it.
Thanks.
Well, heading into 2026, home buyer momentum has climbed as pending home sales in November saw the largest jump since early 2023. But with mortgage rates barely budging, rates remain elevated enough to keep many aspiring buyers priced out of the market. For more on the trends shaping up in housing for the new year, let's welcome in here Corcoran Group broker Noble Black. Noble, it is good to see you. Maybe start big picture, Noble. The American housing market as you turn to 2026. What are you expecting to see, Noble? Compare and contrast it to 2025. It was about high borrowing costs, high prices. What do you forecast?
I think it's going to be more of the same, but a slightly better version. I think it's going to be somewhat of a reset. Rates will come down, I think, a little bit more, but not nearly as much as we want them to, or as much as we thought they were, let's say 6 or 12 months ago. But I think it's moving in the right direction. I think another big positive piece of information is you've got a lot of eyes from both sides of the aisle focused on affordability. There's a lot of different solutions. Some people are just saying we're going to fix it without solutions yet, but at least that's something that's getting attention. And I think really around the country, that's something that needs to be solved. So at least there's energy there, I think, in a way that's not been there in the past.
To your point, a lot of talk on both sides of the aisle. We know we're talking nationally. But if you turn your attention regionally, Noble, as you look at 2026, would you guess, okay, there's going to be certain regions that will be relatively stronger, relatively weaker? What do you think?
Yeah, I think in general, everything's going to do slightly better than what it's been doing for 25, right? You're definitely seeing the Northeast definitely doesn't have enough supply. I think prices there are continuing to rise. You're seeing softness in some of the Sun Belt, some of the South, some of the Southwest, like Southern California. That's where places, basically Texas, Arizona, Florida, places like that where they did a lot of building coming out of COVID, where there were less regulations, less restrictions. They're catching up with that inventory, so prices are softer. But then around the country, it really is market by market in terms of what the job markets are like, what the prospects are economically there, and then where housing prices are.
What do you see in your market, your area of expertise here in New York?
I do New York, yeah. So I do New York City and the Hamptons. We're very strong. We had an incredible year this year. I think going into next year, we're expecting that to be better. I'll tell you that, really for the last probably 15, 16 months, we've been on a tear, and I think that will continue. It's very specific, even within New York City, though. It's almost block by block. So, if you're looking downtown, something that's turnkey, the prices are astronomical. There was something that was signed 2 weeks ago downtown, the largest number downtown, for $129 million. Huge, right? But then it's a buyer's market if you're looking at something that needs work on the Upper East Side. So it really is very specific of what you're looking at. The Hamptons are very strong for prime product. For the kind of entry level, it's a slightly different story. But I think with my market and then also nationally, you've really got to get in and kind of see it's the specifics and it's the local is what really matters. It's not one giant kind of take on the whole.
Now, because your expertise is New York, I got to ask you, Mayor Mamdani, are you seeing any signs, Noble, of an exodus by the wealthy, making tracks to Palm Beach? Are you picking up on that? Are you seeing that? Are you hearing that anywhere?
I'm hearing it all the time. Like everyone's talking about it, everyone's asking exactly that question, and it's a topic of conversation with everyone. The only thing that the numbers have borne out, the only thing that I've seen is after he won the primary, I had 2 clients that backed away. They both came back into the market before the general. The numbers don't bear out that people are listing their homes. We haven't seen buyers backing away. Now, look, I don't think that we've had a mad rush of people buying because he won, certainly. But the market's been incredibly strong. The week that he won the general election, it was one of the strongest Novembers that we've had in 10 years. I think it was the second strongest in 10 years. And half of those contracts, if not more, were signed after he won the election. So, the ideas that he's putting forward, a lot of the proposals that he has certainly are giving concern to a lot of people. But I think, at least for a lot of our clients, there's a thought that, number one, he's going to moderate some of that. And number two, he's probably not going to be able to get what he's talking about done actually done, right?
Yeah.
Or at least a lot of that. And it's not the case. I think everyone, particularly South Florida brokers, are like, come down, everyone's leaving New York. The people that were especially sensitive to taxes left years ago. I mean, that's something that we've definitely seen in the city. That's something that the politicians have to get in control, and I don't think they're doing yet. But the people that were especially sensitive to that have already gone. The people that are scared of Mamdani, they're not the people that all of a sudden, because he won the election, the next day quit their jobs, pack up their family, and move. I think if he does what people fear, that's something that takes time, and I think people have not given up on the city yet, and with good reason.
Let me ask you, you mentioned earlier how politicians on both sides of the aisle, this is an issue now. And we heard President Trump saying he's going to prioritize housing affordability. I think details are kind of scant there still. What could he do? What should he do? I mean, ultimately, you want to boost supply, you want to bring the prices down. What would you look for there?
Yeah, I mean, look, I think that boosting supply is definitely the biggest thing. I think that's what's going to get us out of this. It's not, it's not about curbing rents or anything like that. Most of that, unfortunately, is at the local level, right? So it's a matter of like, what are these localities, the states doing? I think the thing that the federal government can really do is set examples. So have commissions that come together and say, look, these are the bare minimum standards that we need to have. All of these other rules and regulations, let's condense this. Let's cut red tape. There's definitely a role for the federal government to go in and cut out the unnecessary bureaucracy that's standing in the way of things. And we can go through countless examples of, energy standards or, disaster standards, all of these things that are well-intentioned, but they add cost onto the cost of a new home, which make it that much harder that somebody can afford that, right? And ultimately, we want people to afford housing, not to live in the most safe or the most environmentally friendly house they can get, but it takes them 30 years to be able to afford it. I think setting the example with that is the biggest thing, and really going through and looking at each of the different departments, the different bureaucracies, and what can be combined, and what are the best practices, and what are things that are standing in the way of what our goal is.
Noble, great to have you on the show today, especially on set. Thank you, sir.
Thank you.
Appreciate it. We are wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell on Market Domination Overtime. And welcome to Market Domination Overtime. Stocks closing the day lower. Our very own Inez Ferre is standing by with the latest. Inez.
Josh, we are looking at losses across the board when it comes to the major averages. The Dow down about 0.5%, the NASDAQ composite down also about 0.5%, and the S&P 500 down the least, down by 0.3%. Small caps also losing today, down less than 1%. I do want to check out the 10-year Treasury note. That's been at 4.12%. And then just taking a look at the U.S. dollar index, that's hovering just above 98. Looking under the hood at equities, we have seen on the sector action, energy stocks doing the best. We saw oil today jumping, real estate and utilities also in the green, but consumer discretionary and consumer staples and financials, or materials, I should say, all leading to the downside. Over on the NASDAQ 100, Tesla down more than 3%, Nvidia down more than 1%, but we are seeing a mixed picture when it comes to the Mag 7. You did see Micron up more than 3% today. And over on the Dow, you can see there some of the banks that were under pressure. JP Morgan down more than 1%. Looking at crypto, we are seeing, again, Bitcoin in that tight trading range, hovering above 87,000 per token. Strategists are saying that they're expecting that in January you could see a bump when it comes to Bitcoin. But I do want to point out the trade of the day that has been talked about so much as well, and that is the metals trade. Gold retreating from its all-time highs. Gold down more than 4% at around 4,300 per ounce. And then silver is the one that really has been retreating quite a lot. And that is after, excuse me there, I'm going to put back that full screen, but that's after silver jumped to $80 per ounce and then absolutely tumbled down more than 6%. Look, it was a parabolic ride for silver, year to date up around 150%, while gold is up more than 60%. So quite a rally, and we'll see if this leg back pushes these metals even lower in the coming days.
All right, thank you, Inez. Appreciate it.
Thank you.
Well, Wall Street completely bullish on stocks in 2026. According to Bloomberg, not one strategist is forecasting a decline for the year, with the average year-end estimate at 75.55. So what are the potential headwinds and tailwinds facing markets in 2026? Here with his insights is Andrew Graham, Jackson Square Capital Managing Partner. Andrew, it's good to see you. So let's start on the macro, Andrew. You say nominal GDP could accelerate in the first half of the year. Maybe start there, Andrew. What do you think could drive that? Are you looking at monetary stimulus, fiscal stimulus? Is it AI? And what are the odds, you think, Andrew? How confident are you that could play out?
Yes, Josh, to all of it. I think the big drivers, as you kind of turn the calendar into next year, are going to be the tax cuts that are already in the pipeline, right? That we're going to be seeing right out of the gate. That's number one. Easy financial conditions. The dollar's, been relatively weak. That's probably a good thing, along with stock prices that have been pretty strong, through the end of the year. And then the last point is sort of like an easing tariff burden. And I don't necessarily, feel that's happening now, but there's the administration has the ability to throttle that down as you go into midterm elections. So that may also be an incremental driver. But all that up against a backdrop of just the other forces going on, deregulation and the rate cuts that you mentioned, as well as maybe a geopolitical competition that is maybe overlooked, that I think is driving a certain point of that growth. But if you get nominal GDP growth that exceeds expectations, you're going to have earnings growth that exceeds expectations. There's a decent positive correlation between the two. And so most people are penciling in S&P earnings growth of around 14% year over year next year.
Let me ask you, Andrew, a risk you actually highlight, speaking of the macro, is running the economy too hot and that forcing the Fed to tighten. What would be the early signs and signals, Andrew, as an investor you would be watching to see whether that's actually playing out? I mean, would you be watching wage growth, inflation reports, financial conditions? What would you be looking for?
I'd be looking at the shape of the yield curve. Really, you'd be, 2-year yields would start to move higher. The longer end of the yield curve would be static or would be moving lower. So flattening of the yield curve would be your first clue. I don't think we're there, at all. It's just the most conceivable bearish scenario that, I could dream of at the moment, that, the U.S. and Japan, they seem to have made a decision here to run both economies hot. Which looks like it's going to work here in the U.S., at least at the moment. But you run it too hot and the Fed turns around and has to hike rates. I think that would, that would be a bad thing for stocks. We would have a bad outcome in that scenario. But that's what I came up with as a bearish scenario. But there'll be more, I'm sure, that come along throughout the year. This is an evolution, and I kind of cringe when I see the 2026 year ahead forecast, just because the likelihood of those being accurate is pretty low, in my opinion.
Let me ask you, Andrew, you mentioned the earnings growth for next year. Do you think you're going to see earnings growth in 2026 that you say, okay, yes, that's earnings growth that justifies current valuations?
Yeah, I don't expect much multiple expansion. By the way, I'll just say this would be a lot of people talking about how expensive things have become and so forth. The NASDAQ 100 trades at roughly 25 times forward estimates, which is where it's been on average for the last 7 years. So I want to put that in there just to mention it, because we hear a lot about valuations and so forth, but we're not looking for any multiple expansion whatsoever, and think it can come from earnings growth and the pipeline. If you look at networking equipment, which is our favorite space as we start the year, that's where we, the place where we choose to at least start off swimming. You've got a 25% premium over its pre-AI multiple, which is pretty small relative to the group that is guiding towards, and I'm talking about the networking equipment stocks with AI exposure, guiding to 80% earnings growth in 2026 as a group. That's not even trying to pick out the winners. So I don't know. It's the right place to be. For now, we'll see how it goes, but there's going to be this doubt that creeps up, this uncertainty about the AI CapEx spend, and it's good. It's okay. I see it as a feature, not a flaw of the AI cycle. And when you get those sort of uncertainty, skepticism pullbacks, I think it's an opportunity to reload, especially in networking equipment.
So that uncertainty you're talking about there, Andrew, in terms of this data center financing, at least for some names, you would say, okay, that's uncertainty. That's not real fundamental risk right now.
No, I don't think it's a fundamental risk. I just think when you take the CoreWeaves and NeoClouds and take Oracle, sort of a latecomer, and that doesn't really have as much room to issue debt. Neither does CoreWeave necessarily, and they don't have the free cash flow really to keep up with the others. I would lump in, of course, OpenAI and Anthropic as not having the free cash flow to sort of meet their data center ambitions. Those are all legitimate concerns, but I don't think it's going to slow anything down from the legacy hyperscalers who do have ample free cash flow, and they've got tons of room on the balance sheet to issue debt if they choose to go that route. So scaling laws still apply. We expect the trend to AI CapEx trend, which is looking like 50%, kind of growth year over year. I don't know if you come up with a higher number. If at any point those numbers start to move higher, I think this little uncertainty pothole that we're in evaporates, and then you do get a tiny bit of multiple acceleration. But it's really about earnings growth, and earnings growth in networking equipment, I think, is set to inflect higher.
And before I let you go, Andrew, let's just get to some picks. Are you laying out just there? Because I was going to ask you, why is Arista a buy?
Okay, so the scale up, right, which is what's going on now before scale out, building more data centers, putting in servers and server racks and so forth. Scale up is about adding compute. It's basically adding to the XPU clusters, so to speak, and inside each rack, and then connecting the racks to each other. That leads to a higher attach rate. It drives exponential growth in switch equipment. And that's what Arista does. Arista makes Ethernet-based switching equipment. And when people are looking for an alternative to GPUs, right, they want to diversify away from Nvidia just because they don't want to be captive, obviously, in the higher prices and so forth. The TPU architecture, for example, you're going to see more of that to drive inferencing costs lower. But that just drives exponential growth in networking switch equipment. And as you go from NVIDIA-based, InfiniBand to Ethernet, I think that all lands at Arista. And Arista also has $2.5 billion in deferred revenue, which will be coming off over the next 18 months, 2 years.
Yeah, one more I want to squeeze in here, Andrew. Coherent. Now that stock has soared about 100% in 2025. Is it still a buy here, Andrew?
Absolutely. Yeah. I mean, Coherent, Lumentum, Fabrinet. These are optical transceiver companies. They're important components, as you slowly have to move away from, copper-based equipment. And I think that the, move from 800 gigs to 1.6T to 3.2, it's all happening much faster than anybody had expected. And there's an opportunity not after we get through this scale up architecture, there's scale across, which is after that. So we're going to be connecting data centers with each other, and that's all going to require optical equipment. And I expect Coherent to be the one that's closest to being able to meet the surge in demand. So that would be our top pick there.
Andrew, great to have you on the show today. Appreciate your time and those picks. Happy New Year.
Happy New Year, Josh. Thanks.
Lululemon's founder, Chip Wilson, launched a proxy fight at the struggling athleisure company, nominating 3 independent directors to the board, just days after the announced exit of CEO Calvin McDonald. And here with the details on this, our very own Brooke DePalma. Brooke.
Good afternoon. Certainly what we're seeing here is the stock see a bit of momentum today. It was up about 2% against this broader backdrop, a bit of a pullback. So certainly investors seem to be pleased with this initiation of founder Chip Wilson nominating these 3 directors. And it's pretty unusual for a founder to launch a proxy fight against the company. But Chip Wilson, to his credit, he still does have about an 8.4% stake within Lululemon. And as you can see on the screen, he nominated these 3 independent directors. And so this includes former On Running CEO Mark Maurer. He obviously launched On Running, which is now a global competitor to Nike. On top of that, he also is out of a job. He left the company earlier this year. We also have a former ESPN director that oversaw marketing, but in particular, she helped launch ESPNW, so really a focus on female sports there, or rather females within sports in general, and also a former Activision executive, and that former CEO of Activision really had a focus on Call of Duty, one of the key franchises that Activision's largely known for. And so he's really hoping that these 3 nominations to the board could help relaunch the brand's strength, could really help rebrand Lululemon to what it was once known for. And I think it's also worth noting that on top of this, over the past month, after CEO Calvin McDonald planned to announced those plans to step down, we also had activist investment, Elliott Investment Management step in, took a $1 billion stake within the company. And then we've seen this momentum within the stock. It's up about 15% in the last month. Today we saw the nearly 2% pop, but year to date, still down about 40%. And so clearly investors like this bit of a shakeup that's happening at Lululemon right now.
What about the company's product? I mean, what they have on shelves now, what we know is in their pipeline. I mean, is it the right product to really set itself apart next year? And what is a very competitive environment to find itself in?
Yeah, very competitive environment. And also what I found is that there's quite loyalty and a lot of opinions about Lululemon circling around the internet. I posted on TikTok, I said, when was the last time you guys went to Lululemon? They're getting a new CEO. Here's what you need to know. And people got back to me and they said that the quality of the products are not what they used to be. They also said that the price of the products are not what they used to be and that they've went elsewhere. And as you can see on the screen, we got some comments from that TikTok, Dana, saying that the quality has declined so much. My leggings from pre-COVID are in better shape than the newer Aligns being one of their key products. I think one of the issues is they keep making the same exact color in 100 products, rather in 100 colors. I'm only going to buy 1 or 2 scuba hoodies before I go spend my money on something else. That was scuba hoodies, another one of their key products. And Nicolette said, I feel like I go to Athleta way more often because they always have sales where Lululemon never has sales. And so clearly consumers have this perception of where Lululemon is. The quality is not the same. The prices are too high. And also they're going elsewhere. Alo, Vuori, Athleta are just some of the companies that have launched in recent years and really taken market share from Lululemon. And clearly consumers have lots of opinions when it comes to these companies that the company really needs to figure out.
Yeah, I'm just looking here. Let's look at the street. I mean, most analysts far and away still on the sidelines on this one.
Yeah.
All right, Brooke, thank you. Appreciate it. Well, coming up, could the recent slide in Bitcoin be a tax advantage for some investors? We get tax loss harvesting tips from an expert next on Market Domination Overtime. It's been a wild year for crypto, Bitcoin hitting record highs and experienced major sell-offs. Now the cryptocurrency's decline is creating more opportunity for tax loss harvesting. Tax loss harvesting means selling investments at a loss to offset your capital gains and lower your tax bill. Join me now, we've got Lee Baker, Claris Financial Advisors founder. Lee, it's good to see you. So maybe, Lee, we'll start with the basics here. It might be useful. Could you give us, Lee, a plain, simple example, a hypothetical, Lee, of, let's say, a stock gain and a Bitcoin
Absolutely.
loss, and how they would sort of interact on my tax return?
Yeah, absolutely. So imagine, if you will, back in January of this year, or perhaps even let's take it a few weeks farther back to December of 2024, and perhaps you bought a few shares of Delta Airlines. And Delta's done pretty good here in 2025 so far, and you made maybe about $10 a share on that Delta transaction. But as 2025 played out, you got real excited about Bitcoin, and around fall, Bitcoin's up at about 126,000. You go, wait a minute, I got to get in. I don't want to miss the boat. And here you are, 8 or 10 weeks later, and you're starting to feel bad because Bitcoin has dropped by, down to the, 86,000 range. You can take that loss in Bitcoin that you've experienced here in the last few months and use it to offset some of the money that you made in Delta over the last 12 to 13 months to help out your tax picture significantly.
So, Lee, that was a perfect example. Very well said. You make another point here, which I want you to highlight for us. Crypto doesn't currently follow a wash sale rule the way stocks do. Explain that, Lee, why that's important. How does that impact investor behavior?
Yeah, because at the end of the day, we got to remember, we've always got to have a little bit of a conversation with Uncle Sam, if you will. And so the rules set forth by the IRS say that, hey, listen, you can sell something at a loss. You can turn around and buy something else, but you can't buy that same thing or something very similar to what you sold within a month. Otherwise, they're going to say, hey, listen, you can't have that deduction. So as an example, I can't buy Delta today, turn around, sell it tomorrow, and re-enter it and take a loss if there had been a drop in Delta today. So that's really kind of the wash sale rule says, listen, you got to sit out, so to speak, for at least a month before you can get back into that specific game or that specific stock. Otherwise, we're going to say no to that deduction.
So just to make sure I'm understanding, that means if I'm a long-term Bitcoin bull, I could sell today for a tax loss, but then buy it back almost immediately without a penalty.
Yes, and that is very specific to Bitcoin or cryptocurrencies, right? Right now, and again, this is one of those opportunities where, hey, we may look up in a year or two and the IRS has sort of tightened the noose, so to speak, around that opportunity. But as we stand here today, if you're trading directly in, Bitcoin or Solana or one of the other cryptocurrencies, you're absolutely right. We can sell today, take the advantage of that loss we've had here over the last few months and get right back into Bitcoin, because we think that, there's been a pullback, but we think things are going to look a lot better in 2026.
Does the strategy we're talking about here, Lee, tax loss harvesting, does it work the same way for spot Bitcoin as Bitcoin ETFs?
No, it does not. And that's a great question. So we've had a lot of entrants into the fund complex, if you will. So the BlackRocks and Invescos of the world have made it a lot easier for regular folk to invest in Bitcoin and cryptocurrency. But those are registered as funds. And so if you buy an ETF or an exchange traded fund or exchange traded product that invests in cryptocurrency, then you've got the traditional rules as it relates, as though it were stock or another mutual fund. So it'd be just like if you sold one S&P 500 index fund, you couldn't turn around and say, hey, listen, I'm avoiding wash sale because I sold my Vanguard S&P 500 and turned around and bought a Fidelity S&P 500. So that's an excellent question. It is, in fact, different if you buy crypto through a fund.
One question I always have, Lee, let's say you engage in this kind of tax loss harvesting. How long, Lee, do you tell clients, okay, you need to keep your paperwork, you need to keep your records in case the IRS comes knocking and asking questions? I mean, is there actually a time frame you should keep it, Josh? 1 year, 3, 5, 7?
Yeah, so I like 7, and part of that's because everything's digital nowadays. Now, if you're investing directly in cryptocurrency, you've got some additional things to take into consideration. Access. If I've got an account at Schwab and I lose my password or something along those lines, I can get that back. But again, we've talked in the past about those parameters around making sure that you keep access to all of your crypto information. So again, since everything's digital, keep it 7 years. You might have somebody argue against all the space we're taking up by keeping digital copies of everything, but 7 years is a lot easier to handle. At least you don't have that much paper lying around the house.
Finally, as we spin ahead to 2026, I'm just curious, what's going to be changing, Lee, between the IRS and crypto? What do we need to be aware of?
Okay, so one of the biggest changes that's coming is there's going to be a new 1099 that everybody has to be aware of, and it's the 1099-DA, think digital assets. So for years, we've been accustomed to getting 1099 miscellaneous or 1099 div for years. One of the things that's coming now is the IRS has told all those folks, hey, listen, you're going to have to start issuing a 1099 for people's cryptocurrencies, and that will be the 1099-DA, like digital assets.
Lee, great to see you on the show today. Thanks so much for your time. Appreciate it.
Thanks for having me. I've enjoyed it. And Happy New Year to you.
You too, sir. Time now for what to watch Tuesday, December 30th. We're going to start off here on the Federal Reserve. We'll be getting minutes from the Fed's December FOMC meeting at 2 p.m. Eastern. Investors will be parsing through the minutes to see how divided policymakers really are after the Fed delivered the third rate cut of the year earlier this month. Several officials dissenting at December's meeting, but for different reasons, underscoring a Fed that's far from unified. The key question now, how cautious policymakers could be in 2026 and what it will look like with a new Fed chair. We'll also be getting insight into home prices on Tuesday with the Case-Shiller Home Price Index for October at 9 a.m. Eastern. Prices expected to cool slightly, up just 0.1%, signaling that homes are still getting more expensive overall, but not as quickly as the previous month. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3:30 p.m. Eastern for all of your coverage leading up to and after the closing bell. Good night.